John Keats described autumn as the season of mists and mellow fruitfulness, close bosom friend of the maturing sun. But as we move into mid-October, central bankers, economists, investors and politicians will be looking at the misery index this coming week. Now remember that this benchmark adds together the unemployment rate and the prevailing rate of inflation, and updates on both are due from the Office for National Statistics on Tuesday the 17th of October for jobs and Wednesday the 18th of October for prices. So the latest readings were as follows. Unemployment was 4.3% for the 3 months to July. That was still low by historical standards, but it did represent the third straight increase in the jobless rate and took it to the highest mark since autumn 2021. To perhaps suggest that higher interest rates have started to act as a drag upon the UK economy. Economists and policymakers will also keep an eye on the job vacancies number in August. That dipped to 989,000, the 14th straight decline, and the first number below the 1 million mark since July 2021. Meanwhile, inflation eased again to 6.7% in August using the Consumer Price Index or CPI as the benchmark. Now that's still nearly 3.5 times the Bank of England's official target, but it did at least represent a further decline from July's 6.8% and was well below last October's peak of 11.1%. So, for July, the last month when we have the data for both numbers, the misery index score was 6.8 plus 4.3 for a total of 11.1. And that's still above the average since January 2000 of 8, and it will therefore be interesting to see the latest reading in the monthly consumer confidence survey from consultants GfK. That's due on Friday the 20th of October. To continue the big rally from last autumn's lows, the headline index improved by 4 points to minus 21 in September, the best score since January 2022. We'll now find out if a renewed surge in oil prices, coupled with signs of softness in the jobs market and higher interest rates, is having any effect or not. Note how the misery index, shown here in reverse order, does seem to bear some relationship to the GfK consumer reading, which I guess makes sense. Now on the company front, the third quarter results season in America is about to go into overdrive, and here in the UK we have a decent list of scheduled trading statements with around a dozen FTSE 100 firms among those due to update their shareholders. Names which may be worthy of further research include the following, either because of what they say about themselves, their industry, or the economy more widely, although these dates could yet be subject to change. So at the moment we have Rio Tinto and GB Group on Monday the 16th of October, Bellway and Vanquis Banking on the 17th, Segro, Antofagasta, Quilter and IRHI Magnesita on the 18th, London Stock Exchange, Relics, Decra, Rank, Centamin, Dunelm and Sabre Insurance on the 19th, while Intercontinental Hotels, Foxtons and Naked Wines will round out the week on Friday the 20th of October. But for all of that list, the company which could just cause the biggest fuss in the week ahead is Whitbread. The owner of the Premier Inn hotel chain and Beefeater, Bar and Block and Cookhouse casual dining brands is due to report its first half results for the 6 months to the end of September on Wednesday the 18th of October. Shares in the FTSE 100 member are up by around a third over the past year, enough to rank Whitbread in the top 20 performers in the index over that period. Now this gain is being fueled by an improvement in consumer confidence, as we've just discussed, increased hopes that the UK will dodge a recession, and a strong set of full-year results in April, when the outlook statement was also very upbeat. The shares have lost a little ground of late since then, despite June's positive trading update, when Chief Executive Dominic Paul reaffirmed that Whitbread was on track to meet expectations for 2023. The first figure as we look at these 6-month numbers that analysts will check is revenues. In the first half of last year, Whitbread generated sales of £1.35 billion. The first quarter showed total revenue growth of 19%, with the UK up 16%, with accommodation up 18% and food up 10%. Germany was up 124%, with accommodation and food and drink more than doubling, and overall like-for-like growth was 14%. Note that consensus analyst forecasts for fiscal 2024-23 as a whole currently assume 11% sales growth to £2.9 billion. Then analysts will turn to costs. Whitbread's already quantified likely cost inflation at between 7 and 8% for the year to March 24. The three-pronged approach to tackle this and boost earnings in the face of it is to cut costs by £140 million by 2025, grow room numbers, and reduce losses in Germany as the operation gains critical mass. Then in terms of profits, revenues minus costs, well, Whitbread made pre-tax profit of £307 million on a stated basis and £272 million on an adjusted basis in the first half last year. So that's the benchmark for these interim numbers. For the whole fiscal year to March 24, the current consensus is pre-tax profit of £490 million compared to £413 million on an adjusted basis and £375 million on a stated basis in fiscal 2023. Finally, attention will switch to dividends. Whitbread continues to run a £300 million share buyback programme, while analysts are looking for an increase in the full year payment to around 86 pence a share from 74.2 pence a year ago. This suggests a healthy increment on last year's interim distribution of 24.4 pence a share is on the cards. More strategically, analysts and investors will look to Mr. Paul for comments on unconfirmed press reports that Whitbread is preparing to sell some of its pub and restaurant operations. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you next time.